The words negative gearing gets thrown around all the time. Knowing how to depreciate your property plays a huge part in this. Hey everyone, Tuan Duong, founder of Duotax, here for another video designed to help you become a better property investor. Negative gearing is one of the most talked about topics when it comes to property investing. So I'm going to share some information about negative gearing and how it impacts depreciation. So stay tuned. Before I start unpacking negative gearing, I want to be clear that this video is for informational purposes only. In no way should you interpret this as tax advice. We always recommend working with a qualified accountant or tax agent to give you the best advice for your situation. Let's start with what the term gearing means. In simple terms, it basically means that you borrowed money to buy your investment property. If your property is negatively geared, it means that your property isn't generating enough income to cover the cost of the loan and potential other expenses too. So, essentially, you're running at a loss. Now, I know you must be thinking, why would I want to be running at a loss? Well, in terms of Australian tax law, it's not actually all that bad. And that's why you hear so many investors using it as a strategy. The ATO allows property investors to deduct any losses they make on their investment property from their taxable income. So, if you're buying a property for long-term growth and aren't necessarily looking to make money from rental payments, then negative gearing could work in your favor. In these situations, investors usually use the rent to cover as much of the property expenses as possible and personally cover the rest while waiting to hopefully cash out on the property's capital growth in a few years. Let's look at a simple example for illustrative purposes. Linda bought her first investment property in 2020 for $330,000. She covered some of the costs by took out a $300,000 loan to cover her shortfall. Her annual property expenses total $21,000. Before buying the property, Linda decided to go with a buy and hold property investment strategy and realized that her property is likely to be negatively geared. She's able to charge her tenants $350 per week in rent, which ends up being $18,200 in annual rental income. If you subtract the property expenses, she's left having to pay $2,800 out of her own pocket. So essentially, Linda is running at a loss of $2,800 per year, so her property is negatively geared. The benefit of this situation is that she can now reduce her taxable income by $2,800 and pay less income tax. Another great advantage is that Linda can also claim a bunch of tax deductions on her expenses. So, not only will she be reducing her taxable income by $2,800, but she can reduce it even further by claiming tax-deductible expenses like advertising costs for tenants, insurance costs, her loan interest expenses, and building depreciation. Linda's total cost for the upkeep and management of her rental property costs $3,000, so she can reduce her taxable income by $2,800 plus the $3,000. That's $5,800 in tax savings. Claiming depreciation is also a non-cash deduction, which means claiming depreciation as a deduction means you don't need to incur an out-of-pocket expense like paying interest on a loan or council rates. This means that even though your rental property may be negatively geared, it can still offer you positive cash flow. Using Linda's example of $2,800 in losses per year, if we account for her depreciation claim, which is a non-cash deduction of $7,500 per year, her total tax deduction equals $10,300. Based on a marginal tax rate of 30%, this results in an approximate tax refund of $3,090, making her $290 in positive cash flow per year. A great and typical example of many Australians with properties that are negatively geared, yet positive in cash flow. To find out more about the tax deductions you can claim, check out our other video that covers 17 tax deductions you can claim on your investment property. Now, I have to say there is no one-size-fits-all strategy for property investment. You have to consider all your options and not just watch this video in isolation. If you want to see what other options are out there, make sure to check out our video where we break down Australia's top 5 property investment strategies. Right now, it may make the most sense to gear your property negatively for the tax benefits, while at a later stage, it may be better suited to switch to positively gearing your investment property. Either way, it pays to speak to an expert. So if you have any questions, be sure to get in touch. We're all avid property investors here at Duotax, and our main mission is to help you save where you can and maximize the return on your investment. If you know a friend, colleague, or family member that needs to hear this, please make sure you share this video with them. And if you got a lot of value from this video, check out our YouTube channel to subscribe for more. And make sure you click on the bell icon so that you get notified of the next video. I'm Tuan Duong from Duo Tax. I'll see you next time.